Thank you very much, Andrew, for that great introduction. And yeah, just starting into the discussions, what we really want to ensure is that we talk during this webinar about the BrexIMPACT, and specifically the BrexIMPACT on mergers and acquisitions. So it's not so much about the pros and cons about the Brexit itself, because I think that has been long discussed over the last couple of weeks. And at the current moment, it's really down to the UK sending the letter triggering Article 50 or not. And the EU was pretty explicit yesterday, various leaders from the EU, that they defined there will be no negotiations before Article 50 actually is happening, before the Article 50 letter is being sent, and that they expect that letter within a couple of weeks. So there is a clear expectation from the EU side. On the other side, they also want to provide the British government, and that's absolutely correct, the time to sort out the current situation first before they take the next step, which is, I think, a very fair and important step to do with a former partner, and hopefully also in the future a close partner to the EU. Talking about M&A, this webinar is really for corporations that have an M&A-driven growth or divestiture strategy, and are really focused on that, and then also on the post-merger integration elements that the Brexit actually could bring about. And before we actually go into the options, talking about what could actually happen from here onwards, let me start with a quick story. About 18 months ago, I found myself in a room with a client of us that had just bought 2 brands from one of the largest fast-moving consumer goods companies in the world. It was a US-based client, and they also chartered us not only with the integration, but also with identifying a new local headquarter for their EMEA organization. We looked into London, we looked into Hamburg, Frankfurt, Munich, Paris, and Amsterdam. And if you can think about that, it's quite a responsible decision that you need to take. Ultimately, the management of our client decided for Amsterdam. It would have been a very different picture for them if they would have decided for London at this point in time. Even so, we don't know how it will all pan out in the end. But from the current point of view, that could have been a sensitive discussion to lead forward with the client. Now, the current chart that you see shows the 4 current options for how the Brexit is actually going to be executed. One could be what I call the Swiss model, the other could be the Norwegian model, a third one could be staying even with the EU, and the fourth would be the most extreme one, which is actually leaving the EU in totality. So let's just briefly look at 3 of these models and see what actually would be the impact on the M&A environment. So if we look at a total exit, there would clearly be no benefits of any part from the single market. The UK would really rely solely on the World Trade Organization and the rules they have set up. They could negotiate a bilateral trade deal with the EU, but essentially what would happen is they would no longer be the hub to the EU that they have been for many English-speaking countries in the past. If we look more towards something like the Swiss model, then we are moving closer to the EU. And what it would mean is they would leave the EU, they would not join the European Economic Area, like, for example, Norway, Iceland, or Liechtenstein. And they would negotiate bilateral agreements with the EU to gain access to specific industries in the single market. That would then translate from an M&A environment that the UK would maintain its hub to the EU only for specific industries. And that could be quite an interesting way to actually play it. Now, the Norwegian model is actually a model that would probably come closest towards bridging what the voters have said in terms of they want to leave and what probably the parliament is thinking, because there is a majority for actually staying in the parliament. But regardless of, the Norwegian model means the UK would leave the EU, they would join the European Economic Area. That would mean they would freely move goods, services, and capital, as well as people, within the single market. There would be no benefits from EU external trade agreements. And now the caveat comes, it would require significant financial contribution and people movement. Two critiques that the leavers really have placed on why they want to leave the European Union. In essence, the Norwegian model from an M&A point of view would mean the UK would retain its hub position that they have been for many English-speaking countries, but it would be a bit costly. With having said that, I would actually like to pass now baton on to Ben Gomes-Casseres. He is a professor at Brandeis University, particularly on the international business side. He has focused on alliances and M&A for a very long time in his career. Formerly a professor at Harvard, really focused zeroed very much in onto the M&A and alliances side from a global perspective, wrote 3 very interesting books around the topic. So without further ado, Ben, why don't you take up the floor and provide the listeners with your views on what Brexit will mean for the M&A environment.
Sure. Thank you, Thomas. And thank you for inviting me to participate in this very timely webinar. I hope it's useful to the audience. As you said, I've been working on business combinations. I use that word because very often it's important to realize that the underlying drivers to M&A are also possibly drivers to other kinds of combinations, alliances, joint ventures, etc. And of course, divestments, which is the reverse of the M&A. So I want to bring you through a line of reasoning that I take when seeing the Brexit situation that we're seeing here. And I call these hypotheses because I won't tell you what will happen. If I knew what will happen, I'd be rich, and so would you. But we don't know that, and so we don't predict. But we have some reasonable guesses as to what might happen under certain situations. So scenarios, just like you laid out very usefully, the scenarios of different structural positions that Britain might be in vis-a-vis the EU. That's what I want to try to do today, and then take the implications of that for business combinations of various sorts. Great. So it shows here in the slide, the first 3 things to think about are the time horizon that we're considering. So in the immediate situation, we know this is not a prediction. We know there's uncertainty, and because of the uncertainty, there is reduced investment, or at least reduced incentives to invest. This is a very classic situation. Anytime a company is faced with uncertainty, it has a choice of either investing in the face of uncertainty or holding off until the uncertainty resolves. And so most companies, I think, are going to take a wait-and-see attitude for some period of time in terms of having uncertainty reduced. And that, of course, includes M&A. It includes any major bet, any major investment that is a strategic move of a company will be, I think, slowed down for now. And we already have some indications of that. By the way, one of the interesting ones to watch, and we'll talk about examples maybe later, is the one between the London Stock Exchange and the Deutsche Börse. I mean, that is right in the center of the situation taking place here. And that merger is, I think, up for a vote, at least on the LSE side, next week. So we'll see where that goes. But uncertainty is the first thing to think about. The second thing to think about is in the immediate, sort of next medium run, what would be the impact of some sort of Brexit resolution, whichever way it goes. And there's been predictions that we'd have a GDP slowdown in some places, either in Europe and in UK and possibly globally. Of course, there's been currency realignments, especially the British pound, but others also. And there may be monetary effects, monetary easing or lack of monetary tightening. All of that might lead, again, to an environment that could lead us to certain M&A type of opportunities. So for companies that are beaten down they become exit potential. I think you might see that actually fairly far away from Europe. You might even see it in the technology markets in the United States. Think about, Lyft, or we already had the case of LinkedIn. But when a company sees that perhaps it needs another phase of raising funds in order to expand, and the economy in the next 3, 4, 5 years is going to be slow and hard to manage, those unicorns might be more ready for exit than they were before. So we might have, we might say, buying opportunities. There may be buying opportunities, obviously, in terms of British assets also, if the British pound stays as low as it is. So that's in the medium run. The longer run, which is really the interesting question structurally, which you teed up in terms of the different models that EU might end up in, is the political, economic, regulatory restructuring and restructuring of Europe, as well as possibly implications for global restructuring or globalization. I mean, if what we see in Britain is a reflection of a hesitancy to accept the benefits, or at least the philosophy of globalization of the last 20 years, then we might see repercussions in other parts of the world, including the United States, that might change the sort of regulatory, political, taxation structure that companies face. And that, of course, then raises a lot of issues in terms of how companies combine or recombine to create the value. So let me take that point. We don't know where the long run will go. But given that there is this underlying sort of positioning of the landscape, changes in the landscape, what will happen to the assets of companies that try to produce value, try to produce productivity from those assets? And here I'll mention the word that I use in my book, which is called remix. Remix is a term from music, where companies, where musicians remix tracks of their songs to create something new, something fresh and creative. And that is, in a sense, what companies do when they have business combinations. So when you have Microsoft and LinkedIn tying up, the idea is that they will remix some of the capabilities and assets of LinkedIn and some of the capabilities and assets of Microsoft in order to create something new and something more valuable. Obviously, LSE and Deutsche Börse tries to do that too. And so from that kind of story, we can derive 3 laws of success. And that's what I discuss in much of my work. I want to apply those laws for you now to the situation we face at hand. So the first law is actually a very simple one, which you all know. I hope this does not appear in mirror image, but 1 and 1 is 3. So the idea is that in order to create more value, the 2 pieces, when they put together, have to be more valuable than they were on their own. So when you have this restructuring of the landscape, what happens to that potential? And I would think that there could be new sources of joint value, new sources of creating this 1 and 1 is 3. At the same time, there may be situations where 1 and 1 used to be 3, but now it no longer is. So, for example, the LSE Deutsche Börse situation. In a unified market with Europe and the UK, there were agreements made. There was a merger plan. There were projections about economies of scale, about using London as an exchange location for the EU currencies. Now that's now being questioned. And so we have a situation where what used to be possibly a value-creating combination may not be in this situation coming forward if it runs that way. So that's law number 1. Law number 2 is a little trickier. It's sort of a management equation, is that if you're going to manage 2 pieces together or 3 pieces, you better make them work well. And of course, GPMI is very expert in that. It's the idea of integration. And so whether you have a combination that is a full merger where you need to integrate, or you have a combination that is short of full merger, like a joint venture or an alliance or a partner, where you need to manage the relationship still, the 2 or the 3 must work together in order to actually look like one. And so that, I think, will have also, there'll be implications given some sort of Brexit effect. And the question is, what will happen to the collaboration patterns between partners, between entities in Europe, in the UK, and in China and the United States? For example, suppliers, partners, sales channels. All of these are now in a different ballgame if, in fact, we see some changes in tariffs, some changes in regulations, and some changes even in demand conditions. And so the burden of managing these relationships will rise to the fore. And I would think that many companies will have to rejigger how they do integration and how they do partner relationship management for those that are not fully relational. The third law is a little more complicated to show mathematically, but you get the picture. 1 and 1 has to be divided. You have to split the pie between the parties. So in this case, 1.4 plus 1.6, but it could be 1.5 and 1.5 or any other share. The idea is that the economics of sharing value is what drives companies to actually have an incentive to work together. And so what happens with this Brexit situation, I think the payout to partners in an existing deal or in a deal that's ongoing will change. Because again, whatever happens to the taxation situation, to the tariff situation, the transfer prices between companies, regulations, demand divergence, things where we thought there was demand in a certain direction, and now it turns out, I worked with a company, for example, where they have a joint venture, and they assumed that the growth rate in Europe and the growth rate in the US will be X and Y. And it turns out it's X minus 10 and Y plus 10. So what happens to the payout of that joint venture if your assumptions about demand really turn out to be very different? Same thing in terms of regulations. If we suddenly slap a tariff on one side of a transaction, who's going to take the burden of that? Is it the receiver or is it the seller? These things may not have been fully worked out, usually have not been fully worked out in the existing contracts. In fact, it's quite striking from the news reports about the LSE Deutsche Börse merger that they did not really have a good scenario planning about Brexit. And they joined there, I think, 40 to 50% of companies that did not scenario plan properly on the idea of leave. And so we can expect that many companies will be caught flat-footed in terms of their relationships with other partners. So I think the biggest impact here, there will be ups and downs in terms of M&A opportunities, and there will be changes in M&A deals, but the biggest impact may well be on ongoing business partnerships, business combinations that are in a way ways to do business that the payout and the relationship changes over time. There will be restructuring, renegotiation, recombination of all of these, and including some deal exits and terminations where it did not make sense anymore to stay together. So in a way, Brexit might lead to some deal exits, and we'll have to be conscious of that. And it also hopefully leads to new opportunities. But all of these are hypotheses, and I look forward to our conversation to see how maybe we can sort out some of the likelihoods that you see in terms of the line of reasoning that I presented to you. Thank you.
Great points, and I think they're all spot on. Specifically, when I listened to Peter take from Citibank, who just on an anecdotal basis shared the last 2 days that they had 2 deals derail over the weekend, and that they do expect actually for some to be renegotiated and others actually to come through just because of the Brexit and because of the pound losing some of its strength, and therefore British assets might become more attractive to outside investors, whether they are from the Commonwealth, whether they're from China or from Russia, it doesn't matter. But I think that there is, as you pointed it out very precisely, there is specifically with the timing, immediate, medium, and long term, there's going to be change, and change will hopefully also trigger then some M&A deals.
Yes, now, and Tom, I would add to that that the time is short, right? Because these companies are called flat-footed in a way,
right.
And so those that have a strategy, I'm a strategy professor, so those right. that are doing ad hoc deals are going to be really stuck. Those that have a strategy and know where they're headed, I think will have a leg up on clarifying the situation and revising their plans.
Yep.
And you talked about the potential opportunity of new divestitures. Which kinds of businesses or which sectors do you see as particularly prone to thinking now about potential divestitures? Can you see a trend there?
Well, I think we have a general trend. We see it very much in the United States. We have a general trend that the old conglomerate structures, especially in mature companies that have grown over time. Look at Dow and DuPont, and companies that have grown over time, having many different divisions, have now kind of taken the view that having more focus in their business, or Hewlett-Packard, of course, in their business, will be a better thing. The question is whether this Brexit situation, in a way, raises the incentive for focus. If we look at the UK and the EU and all the affiliated countries as being a very large market where integration was a good thing, that was an incentive for merger, for growth of scale, for integrating markets and common branding and common trade and common sales patterns, etc. If we now see in fragmentation, now it could be just EU versus Britain, or as has been discussed, there could be more fragmentation politically or even economically. And if that happens, then the focus on different countries will come back, and in a sense, whether companies continue to have all their pieces in the same boat, or decide to divest maybe the UK division to run a little bit more independently from the German division, and run independently is another way of thinking about should they be divested or not. So I think the incentives for large-scale integration across markets, which is something that happened, when the EU formed. When the EU formed and the economic economic community before that, we had lots of companies merging together to create more and more scale. And if we're seeing the devolvement of that, then it could well be that we get more and more divestment, so we have focus on different markets.
Great. Well, thank you very much, Ben. Really great comments. I think we'll see also comments from the audience. Andrew, is there anything already from the audience? Otherwise, I would then move on to introduce Riccardo.
Yeah, go ahead, Riccardo.
Okay.
Okay.
Fine. Then next is Riccardo Puglisi. He is professor for economics and politics at the University of Pavia, and he's also a Marie Curie fellow. He won several research prizes in the past decades, so he's he's excellent actually to talk about the economic and the political dimension that the Brexit will have on and the M&A environment. Riccardo, without further ado, please.
Yes, thanks a lot for the presentation. Good afternoon to everybody. So I'll take the view of an economist, but I will also try to speak about politics because, of course, this situation was triggered by some political thing that happened, i.e. Brexit. And the point is really about uncertainty, increased uncertainty, as was pointed out earlier. And we have to think about the way in which uncertainty impacts the environment, the economic environment, and how this creates, destroys or creates opportunities for investments and for M&A. Macroeconomics is a kind of a weird science, if it's a science, because there's some data, but there's not so much data, because if you think about it, we have 4 figures of GDP per year. That's it for any given country, but still we try to find out something and tease out something out of this data with proper models. And one interesting insight that comes, which is kind of an innovation, is that if you try and add measures of uncertainty, this has been done by a professor called Nicholas Bloom from Stanford Business School, actually Stanford Economics. You actually measure by looking at how often uncertainty, the term uncertainty is mentioned on the media, on newspapers. Actually, you do find that in the short, medium term, an increased amount of uncertainty, and definitely Brexit is a kind of big uncertainty, as we've seen. This has got a negative effect. It forecasts, maybe it causes, but definitely forecasts decreases in investment, decreases in employment, and a slowdown of the economy. However, if anything, in the long run, maybe the situation gets better. Why? Because I mean, I'm not definitely a communist, but to cite Mao Zedong, who said that basically there's great confusion under the sky, so the situation is favorable or excellent. Well, you in a situation of volatility, after some time, as Ben was pointing out, especially firms that have got a focus, can find out opportunities that arise just because maybe some stuff was started to be sold at a lower price and there were opportunities to be captured. Here you see, but then we have to think about what happens, because there are various options on the table and we do not know which way UK is going to interact, is going to create new, how much UK is going to divide its destiny from Europe. And here you see data in this slide and the next one as well, a graphical representation of data on trade links. And the first thing you see is that basically of 600 billion of imports, so stuff that is sold by other countries to UK, well, EU imports represent basically more than, let's say, 50% of that. So, and you would see in the next slide a similar picture for exports of the UK, and then the numbers are similar. Actually, you do see a trade deficit in the sense that UK is importing more than exporting. This is relevant per se, but I would say it is very relevant from the point of view of future negotiations, because if we are right, trying to make sense of the uncertainty, make sense of what's going to happen in the politics and in economics, well, it's difficult to do predictions on game theory, on strategic interactions between countries, but definitely take a different case of what's going on, of what's going on now as shown by this data. Suppose you have two countries that trade very little, or a country and other countries that trade very little. Well, then maybe the reasons to keep free trade are lower, while what we see, and this data shows it clearly, is that there are very deep links in between EU and UK that is deciding in this future negotiation what to do. And if anything, it's difficult to make predictions, as I said, but I would be inclined not to give a low probability to the fact that we try and move to a Norwegian type of agreement. Why? Because there's too much to lose from both parties. So that's and especially think about the fact that the imports are actually larger than the exports, and so this is, if you think about European firms, they might be afraid of finding an environment where regulation makes it more difficult to export, where also say on many different aspects, but even say on the human capital kind of aspect. For example, I did my PhD in LSE in economics, in the sense of London School of Economics, not London Stock Exchange, of course. And well, now I think I went there to improve my human capital, possibly. Basically, in the future, maybe that was like doing something outside EU, and there was a different status for students for those who were coming from EU and coming from outside the EU, and the prices were very different. So it's there are close links made of movements of goods, services, and people, and so this would imply that I would give a slightly higher probability to a setting where you keep at least the free trade part. Maybe some kind of a disjoint situation, in the sense that the politics get separated and the economics keeps, at least to a large deal, connected. Why? Because simply too many actors have got to lose out of a complete separation on the economic trade side as well. Then, of course, there's the short term and there's the medium and the long term. Well, at least we have seen reactions. We have seen, say, on the from the point of view of nominal exchange rate, we saw a large drop of the pound compare vis-a-vis the other countries. So it's really a large movement, actually pretty unprecedented if you compare. I'm no finance expert, but that's pretty in the long tail. It's not a black swan, but well, maybe it really looks like a black swan in terms of variations on the exchange market. And you see a drop and then a little bit of underreaction. Then the drop went on for a little while. So this, of course, creates in the short term some opportunities if this kind of nominal exchange rate keep as it is after the drop. Of course, as an economist, I cannot but point out to the fact that what matters in the end is not the nominal exchange rate, i.e. just currency against currency, but the real exchange rate. And then, of course, you have to think about the dynamics of prices. And from this point of view, compared to those who think about Brexit as a complete disaster, I would remind people that UK is a country which has got a pretty strong structural structure, economic-wise, has also entered into a deep and reasonably successful spending review. So in terms of compensation, so think about any negative effect of Brexit. Definitely, I would say that the UK government, with a high probability, has got ways to compensate, in the sense, for example, of going ahead with a spending review, which is a way to, and I don't see Labour as at the moment as very viable politically, but so I see the spending review as a way of teasing firms, so counteracting any outflows through tax cuts. Why? Because with the spending review that is rigorous and credible, tax cuts are credible as well. And so this, of course, it's an element of the environment that must be taken into account, again, in the view of the strategic interactions that are likely to happen in the aftermath.
Mm-hmm. Well, great points, Riccardo. I really appreciate that different point of view that you're bringing into the overall picture. Now, based on what we talked about a little bit earlier, as the Swiss model or the Norwegian model that you specifically stressed, it potentially could also mean that the rate drop of the pound that we have seen over the last 5 to 6 days is actually going to rebound if we were actually going to move towards a Norwegian model. And that probably would also have some impact on the M&A market. On the other hand, if we stay more in a Swiss model and the pound currency rates stay lower, it also means a higher attractiveness, because you just get more for your currency when you buy British assets at the current moment. I mean, yes. We're looking across the board between 6 and more than 10%, and that's sizable in the M&A market when you can actually reduce your pricing by that margin. Absolutely.
Yes, that's a thing. Of course, these kind of movements, if they do not show mean reversion, as you were pointing out, are actually make acquisitions, mergers and acquisitions more palatable, because it's not 1%, it's one order of magnitude larger than the typical things you would see. So so what's a black swan? I mentioned it. It's basically something that a word that looks normal in the sense of Gaussian would rule it out. But actually, what we have seen is that because of in a crisis, this case is a political crisis, you do see interactions, in this case negative loops, negative feedback, such that bad events happen more often than what you would expect. That's what a black swan is, because I saw it being asked in the chat, and so again, I think so. I try, of course, monetary aspects do matter, but I would tell people to try and not only look, of course, look at what's happening on the exchange rate. Of course, this creates opportunities and risks, but from the point of view of the medium-long run, the pattern of trade that was shown in the previous slides, for example, think about the large role played by France and Germany. Of course, they are big economies, but they're big in the trade as well. Are actually the structural elements that make some kind of Norwegian type of outcome more likely. Pay attention to the fact that I've seen discussion among financial people, according to which you would not attach a zero probability to UK reneging or whatever, not following completely the outcome of the referendum, which of course speaks to the fact that at least some parts of the union are viewed as something that is very valuable from a free trade kind of perspective.
Great.
Riccardo, yes,
any further questions?
Is it all bad news? So obviously the uncertainty, if Brexit does indeed go ahead, which is the assumption at the moment, the European EU trade volumes are uncertain and threatened by potential tariff barriers. Is there any good news outside the EU? For example, we know that the Mexican government have already started preparing a draft trade agreement to deal with the UK, which is easier to sign than inside the EU. So are there upsides with trade between UK and the rest of the world?
So, well, I would say that it's, so of course there are upsides, like something that is, there are some, not all economics is zero-sum game, of course, because otherwise we wouldn't have whatever, like growth of GDP per capita in the world. So there's a lot of non-zero-sum, which is good, but at the same time, in the short term, there's zero-sumness in the sense that, okay, well, suppose there's a drop in trade between UK and EU. Well, there are other partners that can show up and raise their hand and say, oh yeah, well, what about starting to trade more? So I would say that this is, I would see compensations. I really believe that game theory gives valuable insights if applied and used in a pragmatic kind of way. So I would see opportunities on that side, but exactly because we have those threats of other countries that can show up and offer themselves as partners, then you would have lobbies and public opinion in the European government, in the European countries, i.e. the one excluding UK and also UK, such that you would say, hey, pay attention. Our exporters to UK might lose because basically other countries might replace us. So this creates, paradoxically, but not that much, a further incentive not to see a complete disconnection of UK from free trade with the EU.
Great. Yep. Thank you very much. With this, I would like to move forward with the presentation and give the baton towards Steve Wood. Steve Wood has been essentially in M&A quite a substantial amount of his career. He has been an M&A advisor for many, many years. He has been global managing partner for M&A and VP of strategy in IBM. He specifically focuses these days on agile strategy, and with this focus on agile strategy, he also zeroes in on M&A strategy because that is part of agile strategy. So without further ado, Steve, do you want to take on the last piece that we'll need to talk about, which is actually a lot talking about the post-merger integration impacts, the immediate things that CEOs actually should be very often and should watch out for, essentially.
Yes, thank you, Thomas, and thank you for inviting me to join you today. I think as the only Brit actually speaking on the panel, I do need to start with the politics and to say that I think it's a very sad set of circumstances that we find ourselves in. And truthfully believe it's an appalling lack of political leadership. And I think that it's something that simply needed never to happen. And I can't quite understand why those people who are paid substantially and have a great deal of trust placed in them to take us through difficult things have failed to step up to the plate. So I think that it doesn't reflect well on us, and I think that it's astonishing because very few people that I've spoken to voted for Brexit. In fact, I wanted to talk in terms of paradoxes now, and I had a number of points to make. Because despite the fact that we are where we are, and by and large I think it's a bad thing, I'm not in the doomsday book and I'm not in panic mode. And in fact, there's a very good question, and there are a couple of questions that I think we can address here, but one is around budget spending in the UK and then the differences between imports and exports in different parts of the UK. Because I think that that's actually a very important point. And I think one thing is I sit on a board in Leeds City, and although I'm not a political individual, see something that is quite significant. And that there's a big difference between certainly the southwest and the north of the country. And whilst to the question about the differences in import-export in different regions, certainly the English economy is by a colossal margin the dominant economy in the different parts. There are certainly elements that could lead to further disruption. And I think it does lead to the point that I do think that our political leaders are not in touch with the feelings and beliefs of our different parts of our society, especially the younger ones who overwhelmingly voted in favour of staying. And they're ignoring the political desire for people to have a closer say over what they do. And they'll have to take note of that, because that's growing in England between the north and the south, never mind elsewhere. Enough of the politics, the paradoxes. Presumption that this is a bad thing politically. Well, yes, it is in the short term, and we've heard so much of disruption. And, you know, no business likes instability and uncertainty. So that political situation, though, the Swiss argument and the Norwegian argument you described, they presume no change in the European Union. And I'm going to suggest that that's possible. But actually, it's not probable. I suspect that Brexit, okay, it's a bad thing. No, it's a very good thing, because it will drive, actually, the politicians who've also failed to pay attention in Europe to the genuine interest of people in, I don't like to use the word sovereignty so much as the political interest in their affairs. Whereas this strategic drivers for M&A are global, and the economic drivers are global, and they aren't going to change. So yes, there's going to be this kind of short-term put the brakes on deals, but there's also going to be a short-term acceleration of deals. Get the deals done while you know the law is not going to change and will be grandfathered. And the drivers, as you said, of the fundamental sort of economic drivers are global. They're not local. Yes, there are local flavors, of course. However, the fundamental drivers at the moment are essentially two things: global and digital. And they're not changing because of the European Union and Brexit. Those are the fundamental drivers for businesses all over the world. And that's another paradox, the new versus the old. Ben talked about corporations that were major corporations that were having to respond to this. And he talked about newer corporations like Microsoft and LinkedIn. By far and away, the biggest driver of change in the world at the moment is the speed with which globalization is happening. We've always had globalization. It's just been the speed at which it happened. When you had to send ships around the world, it took forever. Okay, when you could use telephone transport, it took a lot less time. Right now we have globalization at the speed of clicks. And it knows no boundaries. And actually, the fundamental drivers for all of us are how that develops. So actually, Brexit's a big thing. No, it's not. It's a trivial thing. And if you're in a major corporation globally, sure, it's going to cause problems. It's going to give you uncertainty. It is, in my view, going to add costs to post-merger integration. Because instead of dealing with one set of complex laws, you're going to have to revert to a series of complex laws. But we've done that before, and we can deal with it again. But actually, I want to say something that is cutting through potentially all of that, and it is that a great deal of fuss is made about integration. And I'm very keen to see Ben's laws of value creation. My experience of deals around the world is that there's usually only one really fundamental strategic driver of any deal. And lots of organizations get caught up in integration and miss the strategic value driver. Those organizations that have fantastic track records in post-merger integration are those who really know how to get to that value and prepare for and cut through the nonsense of integration. Those organizations that dwell on huge integration programs are the ones that miss the point. So to some of the points on your slide here around, for example, human resources, you will not tend to see enormous changes in the deployment of human resources across borders. And we still have enormous changes in entitlements, or differences rather than changes in entitlement around Europe. There is by no means enormous integration and validation there, and still hugely different levels of resistance to integration that are well known by those corporations that make the decisions around where to make big decisions. And I don't see that changing in the short term, or with Brexit getting any harder or any easier. So I think those kind of things will always be difficult, and you'll always see the cultural impact. The supply chain piece, I think, is potentially very much more significant because you're seeing the cross-border transactions, and that could start to hit all sorts of problems. And I do think that not so much for the financing for individual corporations for their deals, because they can be driven from their headquarters accordingly, but I see lots of problems with the financial services industry.
That's right.
As an industry of all industries, that's going to have to start to think enormously. I mean, it wouldn't for a moment surprise me if the Bourse and the LSE deal fell through. I mean, they've had 3 or 4 goes at getting together, and now there's a massive change. So I see here paradox. Yes, some deals will die, but others will accelerate because now's a good time to do it. But the assumption of stability in the European Union, I think, is a dangerous assumption, which might well make a drive towards cutting through some of the political nonsense that you see for everybody and starting to make the economics clearer. Because at the end of the day, for me, economics leads the politicians, not the other way around. And this time the politicians have really screwed it up. But the strategic drivers are global and digital, and they will not go away. And there is opportunity here for all countries to start to think about their deal activity. And I think Ben mentioned it in terms of the different types of activity. I.e. not necessarily full M&A, but affiliations. They are sort of partnerships, affiliations, joint ventures are notoriously difficult to do for exactly what we're seeing here, that the term of marriage and happy marriage is great, but as so often happens with marriage, divorce is very difficult and often acrimonious. So I think that, as we've all said, nobody can predict what will happen in terms of the actual activities, but for certain, nobody likes uncertainty, so that's going to be disrupted. But I think that the scope here and the freedoms to negotiate a complete and separate divorce are actually nowhere near as broad as people might think. And those people who've actually voted for Brexit are not really voting for a complete divorce, or those who think they were going to get it are really going to be very disappointed, because actually it's not in anybody's interests to do that, as has already been said. And I think that you'll see something that, my hope is that you will see something, as has been mentioned. I mean, I would love everybody to say, well, we've taken note of this and we need to respond, but we're not actually going to do it. We're going to do something very different, which is renegotiate properly and create actually something which is an easier market, but where the whole issue of the political control is much more moderated. So just keeping an eye on the clock for you, I'll just pause there.
Well, great points that you made, particularly when you show the paradoxes and kind of show the span between one position and the other. I really like that, because it ties into the agile strategy, and that essentially drives how companies look at globalization and look at the market, and specifically on the M&A side. Andrew, are there any questions to Steve from the audience?
No, there are none that have come through to me. I think some people have been chatting directly with the panelists. So if there are any other questions that you'd like to raise, please raise them now. Or of course, you can reach out to any of the panelists offline.
Yeah. Steve, just a couple of questions from my side then. I mean, we know BMW owns 4 plants in the UK where they make the Mini Cooper. Siemens has been quoted that they are actually looking towards rethinking their strategy on power turbines shipped out of the UK. And Vodafone, to my complete astonishment, has said that they would rethink being headquartered in the UK. Are they, to put it mildly, not getting the paradoxes that you identified, or what do you think about those kind of anecdotal information that we've received over the last couple of days?
Well, I think the paradox doesn't necessarily need to be resolved in any one organisation. I think some organisations will certainly relocate their headquarters, and others will choose to be here because of the independence as well. So if you see, for example, if, as I suspect will happen, you will see more animated local debate in other of the major economies in Europe, that won't necessarily make them more attractive. You've seen one of the major banks debate whether to relocate its headquarters, and that was out of Europe altogether. You already see a huge number of corporations locating headquarters in Paris. And indeed, at one stage, IBM's principal point of European operations was in Paris. So I think it is inevitable. Some organizations, because of their particular structures, because of their strategies, will see retrenchment perhaps and movement. If you look at some of the major potential sources of investment to the UK, China, and some of the relationships with Japan, for example, I think they will continue to see London and the UK. Just as, for example, Singapore is viewed as a very good place for a centre of investment for Southeast Asia, that London will still be viewed by many as a very strong place to be, not least for some of simple reasons like language and facility and access. So I think the paradox isn't necessarily a paradox on one item is plus or minus. Two different corporations may make totally different decisions,
right,
for almost the same reason.
But essentially what you're also saying with your comments is that we'll probably see a rethinking in the European Union about the degree and the way the European Union is run, and that there may actually be also the outcome out of it that we have less bureaucracy, less burden, that actually has led to that broader, I should say, not understanding what is going on in Brussels. So that actually may be the very positive thing that's going to come out of the discussions that we are facing at the current moment. And that should then trigger again more M&A activities if bureaucracy is streamlined, if it's more leaner, and if Europe as such becomes again a very interesting focal point. Particularly if you look at the global development 2014, 2015, 2016, we saw a lot of activities in 14 going on, M&A activities going on in the US and Asia Pacific, and less in Europe. That changed a bit because of the weakness in the euro, given the Swiss bank leaving the parity between the Swiss franc and the euro in 2015. That meant Europe became more interesting again. Specifically, the UK was one of the leaders in M&A activity in 2015. Now, with Brexit, there's again change. I can see that. But it also could mean that that change may actually change to the positive come 2017, given that we always need to think about deal times of 9 months plus.
Yeah. So to answer right at the beginning of your question, I'd repeat, I'm strongly pro-European and voted as strongly as I could in staying together. So when I kind of say, I think it would be a dangerous assumption that there'll be political stability in European Union and that all the political instability will be in the UK, I think that is a very dangerous assumption. So yeah. I think, as I said, and I think has been said by some of the other speakers, the sort of law of unintended consequences is at large here, has been set loose and will run wild and free. The assumption that other parts of the European Union will immediately become more attractive because instability in the UK, I don't think if you look into that quite seriously that will be a simple and uncomplicated answer. So that's really what I'm saying. And then there's some other points that have just come up here around questions of tax cuts and antitrust. I think who knows what goes through the mind of a chancellor, and I think that one thing I would say, whether it's real or not, I've always felt that the UK was a very open economy because of the level of inward investment. You see a lot of British firms being snapped up by other possibly more ambitious countries and organizations in other countries around the world. So I think that if I was in George Osborne's shoes or whoever might replace him, one of the things I'd be certainly looking at is how you make the UK continuing to be or even more attractive to inward investment. So taxation is one of the potential tools. There is a big caveat that all the noise that you've seen recently, the political noise, it has to be said, around organizations paying or avoiding or even evading their appropriate share of corporation tax, was going to make that a political hot potato. And I think Ben's raised this point about antitrust enforcement.
Oops.
Steve got dropped.
Yeah, looks like it.
Yeah, he was referring to a short comment I made on the chat.
Yes,
which is, antitrust enforcement is something that goes in waves. At least in the U.S., there've been political populist movements where antitrust against the big trusts, big business has been very strong, and then it recedes. And in some ways, we're seeing a return of that. And the political atmosphere, which questions globalization and in fact, the leadership of corporate elites in a way, it possibly will drive further antitrust enforcement beyond what we now see.
Yeah, I could absolutely see that. Yes, because you want to then protect what's there in terms of economic base. Yeah, absolutely. Great. Yeah, good. Andrew, do we have any further questions from the audience?
No, I don't think we do. So with that in mind, we've run over a few minutes. Thank you everyone that dialed into this webinar. We have Global PMI Partners runs a series of webinars, and indeed I think the topic of Brexit will be one that runs for months, if not years, and so I suspect that we'll run future webinars on this topic as well. Thank you to all the panelists for joining. Really appreciate your advice, and just to reiterate, I'm sure you'll welcome any connections for any of those that join the webinar.
Yes, and what's important is we will make the recording, the replay available on our website. We'll send it out to all participants that registered for the webcast. And again, also from my side, a very, very big thank you to you, Ben, to you, Riccardo, and also to you, Steve. Really grateful for your insights, and thank you very much for contributing.
Thank you for your quick action on this.
Thank you, Steve.
Thanks.
Thanks. Bye.